The concern, right, is that we focus so much on 4%, but if you look at 3%, first of all, it's taken 17 months to get there. And I think the 3% yield on the 10-year, happened for one day and only one day. So do we need more sustained, do we need at least to go at 3% before we even start thinking about 4%, or could it come very quickly?
I think when we look back at the tapes, we had 10-year rates above 3% in the context of global rates being in a different place than they are now. I think that needs to be taken into consideration. So it's not that I disagree with the 4% call, but it seems to me that you have a missing ingredient, which is where the Bund and the JGB 10-year is. So if you are willing to entertain the view that the BOJ lets go of the price level targeting and the ECB starts tapering, then that's very possible in my opinion. But we need to have those ingredients in place.
So how long would that take? Let me bring you over to my chart, Francesco. We're looking at the end of a 30-year bull market. Possibly we put a question mark because these things are very difficult to predict. And you can see the trend. We brought it back to, since 1961. The trend for the yield has been ever going down since 1984. When does it, should we start thinking about 4%? Is it the next 6 months? When you were saying that, there's a repricing of JGBs and Bunds, or even longer?
Look, I don't have, to be clear, 4% in my 10-year forecast. And the reason is that I think the ECB will keep policy rates very low, even after removing the QE, and that the QE effects of the ECB will stay in the price for as long as they don't shed the balance sheet expansion that they have built over the recent years. That shaves about 50 to 80 basis points of the 10-year Bund, and so that will persist. Hence, I don't think treasuries will have the power on their own to go much above 3.5%. So that's the lay of the land for what we know today. But I think when we look at that chart, the past decade, apart from the crisis years, has been characterized by very stable inflation expectations around 2%. Productivity has gone down, so that's why we have lower wages. But you can't say that something fundamentally has changed in the way we should price long-term forward rates.
But is the Phillips curve back this year, or is it a little bit too soon?
Well, I think it's been flat for a long period of time. We're throwing at it a very strong growth in the U.S. and the advanced economies. From 19 onwards, we'll probably have a smaller output gap in the emerging world. We already have commodity prices rising. And, the best you get in terms of wage growth is about 2.5, 2.7, Germany, UK, US. I think there's room to grow towards 3% from there.